guests and not necessarily those in currency. Foreign currency trading, Forex trading, involves significant risk of loss. It is not suitable for all investors, and you should make sure that you understand the risks involved before trading and seek professional advice if necessary. Performance strategies and charts shown are not necessarily predictive of any particular result, and past performance is no indication of future results. With that, I'm going to talk for just a moment about Currensee, and then we will hand things over to Mike. Currensee, as many of you know, and some of you are about to learn, is the first Forex trading social network, where like-minded traders can connect with one another and share unique insights based on the actual trading activity of the network. That means each of the thousands of traders on Currensee has linked a live money trading account. And while they maintain control of their privacy settings at all times, it means that when you are having a discussion on Currensee with someone and are linked to that person as a trading friend, you can actually see the positions and trades that they are executing, which adds a new dimension to the discussion. You can meet Forex traders and collaborate using that data, share strategies, and track your performance against your strategies, against your trading friends, and against the community at large on the live trader leaderboard. And because thousands of members are linking their live trading accounts to Currensee, we're able to aggregate, anonymize, distill, and return back to the community at no charge a set of social analytics that gives you information based on the trading activity of the community. Currensee is free to join, and I hope that you will all consider doing exactly that at currensee.com. Now, it is time to welcome back to Currensee's webinar our good friend Mike Baghdady, a longtime veteran of global financial markets. I understand from good old-fashioned physical assets back in the day through Forex and futures. Today, he is the foremost expert in price behavior. He calls himself a price purist, and we'll find out more about what that means. He is the head trader at Spyglass Trading Solutions, and we'll learn more about them. And we'll also have a special offer from the Currensee Marketplace and Spyglass Trading for all attendees on the webinar. I'll be emailing that out later today. Mike is also a market analyst, columnist, and commentator, and he's going to share some of what's on his mind about trading with us today. Mike, are you ready for us?
Yes, Dan, I'm ready. Whenever you are.
Fantastic. I'm going to hand over screen control to you. And folks, it'll just take a moment to get Mike's charts up on the screen, and then we can begin.
Okay, do you see my charts? My platform?
I do. I can see the MacDaddy radar screen.
Okay, lovely. Okay, good morning, everyone. Good afternoon. And as Dave said, happy Eid and happy Rosh Hashanah. And I hope it's a blessed year for all of us and for everybody that's attending. And thank you for taking the time of your day today to spend some time with us. Without taking too much time of introductions, basically the way we trade at Spyglass and the way we train the traders is primarily using price behavior. And I would like to take a moment to explain to you what is meant by price behavior. First, there will be a PowerPoint presentation or a Power Slides. If you would like to get a copy of it, feel free just to send us your email, and I'll be more than happy to, or send it to David. I would be happy to send you the PowerPoint. What is price behavior? Price behavior, or when I say something that the price of the dollar yen today is trading at 83.70, what does that mean? Primarily, it means that the traders at the market today perceive that this price is a fair market price at this moment. And they will be basing all their trading decision based on what they perceive this price. If they perceive that the dollar yen at 83.72 is a too high a price, they might proceed to sell it because they perceive that the market should be at a much lower date, and therefore they will be acting upon their perception to what this price is by specific action. And that action would be, in this case, shorting the market. If, on the other hand, they perceive that the 83.72 for the dollar yen is actually a very cheap price, and they expect that the prices should go higher, then as prudent traders, they will act upon this information or upon their perception with regards to that specific price at this moment, and they will act upon it by actually going in and buying, and thus the prices should go higher. So the essence is two things. One, price is nothing more than the perception of the traders, and that is why one of the explanations or reasons that at certain times you get those explosive moves that nobody can make any sense of, and you got this something that's moving 200-300 points a day or 200-300 pips a day. This is because this collective perception, when it ignites or when it begins to move, it has this infectious kind of attitude, if you will, and it will take a life on its own. If there is this positivity or this perception that the price is inexpensive and it's a good price to buy, then the traders will start moving towards actually acquiring that instrument, and at that moment in time they will compete with each other. Each wants to buy it as soon as possible, and in that attempt or to acquire, what will happen is they will get into what we call the auction mentality. And when you get into the auction mentality, everybody is bidding on the price, and the prices will go higher because they're all competing. And that's why you could hear the traders would tell you, now the market went to bid. When the market is going to bid, everybody is bidding the market up. On the vice versa, when the traders perceive that the market is negative, then the market is being offered, they're offering it down, and they're making a sale. And that's why we are trying now to identify what is the market perception, if they're perceiving if they are in an equilibrium or in a sideways pattern, if you will. For example, this here, like what you see on the chart, this kind of a decline, this is a perception that the pound is too cheap, too expensive towards the New Zealand, and it took a perception that they want to sell it, and you can see this capitulation, if you will, of over 100 pips in less than a couple of hours. That is a sales mentality. You can see also the same situation if you're looking at the Aussie dollar, for example, this morning. You will be able to look at, and you can see that the dollar or the Aussie dollar has been moving much higher towards the US dollar, and you can see that move again. Everybody is acquiring, and you can see the explosive move to the upside. And if this is the mentality, if this is the perception in the market, if everybody is eager to buy, then that tells us, why should we be going short? Why should we put on top of the market and tell the market, this market is as far as you should go, now stop, turn around, because we are dictating to you that this is high enough. We do not do this into the market because we do not have the ability to predict the market. We don't have the ability to gauge how far or how high is high or how low is low. And there are so many lessons in history about things that went all the way up to the moon, or things went down, something that was of great value and went down to zero. So that's a very short description of what price behavior is. Now, Today is Thursday, as you well know. We're going to try to take a couple of trades together, and I'm going to share with you how we do our trade based on price behavior. The first thing we do, all our trades are very well planned. We take a great deal of effort in planning our trades. And every week on Sunday at 7 o'clock London time, which is around 2 o'clock Eastern time, every Sunday religiously, we join into a webinar like this with our team of traders, and we have guests to come in. And what we do is we begin to plan our trades like what you see here in the radar screen. We have what is known as the long point, the short point, the structural long, the structural short, and the long stop and the short stop, which is the stops for our long and our short position. Planning our trades is an integral part of our trading effort. And I cannot tell you how important a component that is and how it allows us to better our results. So, for example, if you can see here, if there is a number that is red, this means that the last market price is now below, let's say in the dollar yen, below 83.92, and this was the price we went short on as of last week. I mean, these numbers that you see in front of you, these are the result of our trading plan that we did last Monday on the 6th. We did it this week on Monday because of Labor Day. So you can see, for example, we're short the dollar yen from 83.92. We are long the pound CAD from 150.160. As long as it's green, this means we bought it and it's above it. If the pound yen, we're short from 129.15. If it's white number, then we are flat. So basically, we're flat the dollar pound. We are long the Aussie CAD. We are long the Aussie yen. We're long the Aussie dollar. We're long the Euro CAD. We're short the Euro pound. We're short the Euro yen. We're short the Euro dollar, and all to continue. So that is the first thing we do. We identify these price points, and these price points are, as I said to you, we are trying to gauge the market mentality, if they are bidding the market higher or they're bidding the market offering the market lower. Now this sounds to be too esoteric, or how would somebody know if they're pushing it higher or they're bidding the market higher or they're offering it lower? I mean, this sounds to be easier said than done. The reality is, it is as easy as I'm explaining it to you, and it's quite simple, and I'm going to share it with you. First, what we try to do, we identify, let me show you again, a good example was last week in the dollar CAD. You would see, I mean, even before the chart comes up, I will tell you that the number is 103.5003. You see this number over here? This is what we call a structural point. And this was the trades that we did in the Canadian dollar this week. So on Monday, this day, we bought the Canadian because it went above the 103. Let me back up here. So when we identify a value like this, a reference point, which is in this case in the dollar CAD 103.50, that tells us primarily, or gives us, that is a structural point, which means that if the prices are trading above the 103.50, then we as traders can now accept that the market is now in a auction mentality. They are bidding the market higher, and now what we should do is we have only one of two choices. Usually the challenge we have as traders is that at the right hand side of the screen, right there, where I put the question mark, like at this moment we're looking at this chart, And if you forget, we had the horizontal line, the 103.50, and we are now, all of us, going to decide, should we buy the Canadian dollar or we should sell should we buy the US dollar, US CAD, or we should sell the US CAD, or should we do nothing? We only have those three choices. We can buy, we can sell, and we can do nothing. The stuff I'm sharing with you guys is practical stuff. It's not theory stuff, okay? That's why you can see on my screens there is no moving averages, there's no indicators, there's nothing. Why? Because I cannot wait for an indicator to turn around where I'm placing an order in the market. We had traders trading, we have open position, we have to be acting immediately, not waiting for a subjective divergence or even though they're all good stuff, don't misunderstand me, but they are not practical stuff that you can act upon at the heat of the moment. So right here at the right hand side of the screen, you have three choices: buy, sell, or do nothing. You can only make money if you are right in one of those three decisions. So if you buy and the market goes up, you're going to make money. If you sell and the market goes down, you're going to make money. And if you do nothing, you're not going to make money anyway. But if you buy and the market goes down, you're going to lose money. So to put it simply, you have one of three chances to make money, and 2 out of 3 chances not to make money. This means that 66% of the time, you will not. So 33% of the time you will be making money, and 66% of the time, unfortunately, we will not be making money. And I'm going to start quickly doing the sales for you right now, the trade. So in this case, if now I have a significant point or a price point as the 103.50, it boils our decision-making process. It gives us a much more clarity. It increases our odds of success tremendously. This is how simple this methodology is and how clear, and you can quantify the results. So right now, if we are using our classic modes or classic means of trading, I have the chances of making money is 33% of the time, and the chances of not making money or losing money is 66%. Who wants to get involved with a business that they will only make money 33% of the time, and they will not make money 66% of the time? What we need to do is to have it upside down. I need to be sure that I'll be making, or high probability that I'll be making money 66% of the time. And if I'm not going to win, or I'm going to lose, then I'm only losing 66% of the time. That is the right way to trade. So if I have now 3 options, how can I change these ratios? It's quite simple. If now I am able to successfully identify a structural value, i.e. the 103.50, then I can say if the prices is above 103.50, then I only have 2 choices. I can buy, or I can do nothing. Selling or going short the market is no longer an option. If the price is below the 103.50, I can sell the market, or I can do nothing. Buying is no longer an option. So now instead of having 3 choices, I'm ending up by having, or my starting point is 2 choices. Buy or do nothing, sell or do nothing. So I can be right 50% of the time. So my odds of success by simply identifying a reference point, or the point on the chart where the perception of the traders is has changed or has entered into a buying mode, I have just increased my odds of success by 16 percentage points. From 33, now it's 50-50. Then with some techniques and some money management, I can raise it from 50 to 66 or 70%. And even if it's 50-50, with good money management, I will end up making money at the end of the day. So, and I want you to see something again, how to get now the validity or the proof of how a structural point is valid. If you look here, just go with your eyes on the horizontal line, and you can see, for example, here from the beginning of the chart, when the prices broke above the 103, look at the explosive move. That is, if that's not an auction mentality, I don't know what is. The second time it fell below the 103, you see the capitulation. That is a sale mentality. Going back again above to the 103, it enters again into the auction mentality. Everybody's bidding, everybody's chasing this market to buy. And you can see, if I just go every time, look at this. You have 200 pips on either way, on either side of the 103. 200 pips on either side of the 103.50. Up till today and so far, and this was, as I said, on the 7th, the first day after Labor Day, you got your 200 pips. Right now, we are trading at 103.29. So following the same rules, if I ask you, do you want to buy, sell, or do nothing? Well, the answer is buying. You can say, Mike, buying is no longer an option. We are now going either to sell that market, or we might sit aside. But buying it is not going to be an option. All right? That is the essence. And we use the structural points like what you see here on this chart on our radar screen. We identify all these structural points and we enter them in the radar screen. So now we have, especially what says under structural point, structure long and structure short. These are the price points where the perception of the market has changed from bearishness, from buying to selling, or from selling to buying. And this is when I have a price move above a structural point, you have now to start buying. As I said, we do identify these structural points and all our trading strategies every Sunday afternoon. So now looking at this at the radar screen, you can see right now basically your general position with regards to the any currency you want. So for the Aussie dollar, you are in an upward trending mode. You want to be looking at buying the Aussie dollar. So the Aussie dollar is initially a buy unless it comes below the 92.20. So what we do initially in the morning when we come in before we trade, first we take a look at the radar screen and we get the general direction of the market. We want to know which are we in an upward move in a buying mode or in a selling mode. Then the second thing I want to do, I want to look and see what happened in the previous session. So if we look at the Canadian dollar in particular, I just have prepared them for you over here. These are the group of the CAD. And you can see that, for example, we have looked at the dollar CAD, we're trading below the 103.50. Also the Euro CAD. You can see now we are trading at basically at a new low. And now the trend for the dollar CAD, especially breaking below the structure point, that we are definitely now in a bear market as far as the euro CAD goes. And this is something that you want to be, or I would be, so I don't be giving, I would be definitely looking at taking a long-term short position in the euro CAD, because now it has broken, and you can see that the major trend is absolutely to the downside. So the euro CAD is a big sell. And look at the pound CAD also, similar position. And as you see, these are our structural points that we identified from the prior week. And right there, there is your capitulation below the structural point. There is your up move below the structure point. And these structure points act as beautiful, excellent barriers in the market. Why? Because it falls back to the essence of technical analysis. This is what we call technical trading. We're using every element of technical analysis, or the purest of the price action, and we apply it. I'll just give you one simple example. One of the tenets of the theories, or the theory behind technical analysis, and I'm sure all of you heard it before, is that human beings or traders in the market would do the same thing over and over and over again. It might sound so simple. I mean, people don't really, they do the same thing over and over again. But the way we share this thing with you here about technical trading is that we actually believe that this is one of the doctrines behind technical analysis, and we apply it. It is not just we know that it is part of the theory. We know it, we identify the points where traders act the same way every single time. So we identify the points where their perception changed, and if they change their perception, they will act on this new perception, and therefore we enter into the trade, or we take the trade on the belief now that the market perception has changed and that the traders are going to do the same action again, and then we are going to enter into the trade. So we anticipate the movement rather than predicting it, and that's the big difference about being success or failure in trading. The difference is anticipating or predicting. Predicting, we are playing God. Nobody knows what the next tick is going to be. So we don't predict. I don't predict. At least I know I don't know. So I'm not willing to play or take risk on something that I know for a fact that I don't know what the future is. So if I don't know that, and I accept this, that I'm a simple mortal, I'm a human being, and I don't know the future, then I would know that I have the essence that traders will act in the same way, because this is the observation that has stood the test of time. This observation gives me a statistical edge. It increases my probability of success. Therefore, if I can anticipate that this is the structural point, like this, and right here, ladies and gentlemen, you'll be looking at the 165, and you would say yourself, if I ask you buy, sell, or what, or do nothing, you would say to me, Mike, at 165 I'm doing nothing. If it bounces above 169, 165.15, I'm going to be a buyer. If it trades below 165.18, I'm going to be a seller. And now, right now, you know for a fact that you can only be short. You're not even looking to be buying the pound CAD because it's below 165. And thank you very much. and suddenly now you have a trade. That simple move here, guys, is over 1,000 pips. That move is over 1,000 pips in the span of 3 weeks. So on $1,000 investment or a margin, you would have made 10 grand. 1,000% return on your investment in the span of, let's say, a couple of weeks. And it's not just the pound CAD, or it's on every single thing that you will ever trade. It doesn't matter if it's a currency, it doesn't matter if it's a future, it doesn't matter if it's a stock index, it absolutely doesn't matter, because price behavior is human behavior, and human behavior will act the same way across the board. I will always trade this way. My traders that I train will always trade this way. We take out the subjectivity. There is no opinions. My traders in the office, when we are trading and we have a big trading floor, there is no debate. If the pound CAD is below 165.18, there is no discussion. There is nobody would come and say, I think it is low, but it might bounce up. Well, if you think it's low and it's going to bounce up like this, well, then that's a better chance for you to go short at a higher price so you can make more money. But buying it for that bounce is not an option. If he does that, they're fired. And that's why the majority of the traders stay on the right side of the market. So this move, for example, here that you see, that move up, they're not going to be buying this. They are going, instead of saying to themselves, I am going to sell it at 160. No, they would say, okay, now it's pushing back up a little bit. Now, instead of selling it at 160, I can sell it at 163. I have an extra 300 pip cushion that I can take to the downside. All right? So that is how we take the essence of the technical analysis and to turn it into technical application. And that's what we do every single week, as I said. Now, this is the general picture. Now we are going to look at, I'm waiting for the news to come out. I guess the news came out, the unemployment came out. So let's see what's happening. Now this is the dollar pairs. And you can see that the news came out. I don't know what the news came out. I'm not watching it right now. But you see that the dollar CAD is just, the dollar just went up just 1 pip. The dollar yen is up 7 pips, which is basically nothing. The dollar Swiss is the strongest so far. It's up about 13 pips. So out of those three, if I'm looking to have any participation in the dollar, I might be looking at the dollar Swiss. I would definitely not touch the dollar CAD because it's already doing nothing. And just let me explain what this flickering signs that you see. This radar screen basically is one of our standard screens that our traders have. And this scans the market every 5 seconds. And with this, it tells the traders what position he should be in at this moment and what he should be trading and what is the strong currencies to buy and what is the weak currencies to sell. And they can combine this, what we call the portfolio selection. Because portfolio selection, choosing what to buy and what to sell, is an extremely important component of your trading. That selection of what to buy and what to sell is paramount. You cannot, or you should not, say, I like to trade the cable every day, or I'd like to trade the Aussie every day, or I trade the euro, or I specialize in the yen. That's not the right way to trade. You are in the market every day to make money. That's the only reason we are in this business. So if today the market gets into a big auction mentality, everybody is buying, tomorrow they will not be buying again. They have already satisfied their needs. They are done. If I today had an order on the floor to buy 5,000 contracts of something, if I already buy my 5,000 contracts today, while I'm buying those 5,000 contracts, I am pushing the market higher. So once I bought what I needed, I will not be acting the same way tomorrow. Tomorrow I will be resting, or I will just be making market. But I will not be taking a huge directional position. The same thing with your Goldman Sachs, the same thing with your Merrill Lynch's, the same thing. If they have a big order to fill, whether in currencies, whatever, they will be acting upon it today. They will be in the market tomorrow, but not with the same size, not with the same conviction, not with the same force, not with the same strategy of how to accumulate whatever they want to accumulate, or how they are going to liquidate what they are liquidating. There are strategies that people use when they're buying, and there are strategies that people use when they're selling. But there are strategies that people use when they're just plainly in the market, making market without any directional bias. So, if they are today committed to one side of the market, this does not mean that they will be committed to the same side in the next following day, unless it is what? Unless it is a structural point, guys. So, if the prices like here, for example, is above, like let's say the dollar CAD is below a structural point, then I can, and it stays below the structural point, then I and you should know that the market now is remaining into that mentality, or they will be continuing to act in the same fashion or in the same direction, and thus we should still be shorting the dollar CAD. And if you see right now, the dollar CAD, the structural point is 103.50, and right now we are trading at 103.25. So you're up. It flickers, it moves up and down because it's scanning the market, as I said. So we're still basically just looking at this. I'm short the dollar CAD and I'm short the dollar yen. So with the radar screen, as I said, it scans the market every 5 seconds, and it brings on top here the position that I should be doing or should I be trading. So for example, the dollar yen, it is long, strong reversal. This means what? This means that the dollar was trading down, now it has reversed, and now it is moving up. So if I click on the dollar yen symbol, we will come with our intraday charts. The intraday is just coming up. 1 second. For some reason it's taking a little bit longer time. Right, and that is you see that the dollar yen was coming down. It stopped going down and it turned around. So now I have, just without even looking at the chart, I know that the dollar yen was down. Now it has reversed and it's going up, and that reversal is strong. Look at what the radar screen is saying. It says it is a strong reversal, and you can see that momentum coming in. It is a strong reversal. So now, reversal is a change in perception. Reversal means that the market is now forcefully going to the upside, and I can see that this momentum that's coming into the market, that this is a forceful, a strong reversal. This means that the traders now are committed to the long side. So right there, now I don't have an option to be a seller. What I have now is either to buy or to do nothing. And if I wanted to buy, then I'm beginning to time myself into how to get into the trade at the best possible time. You don't want to be buying the top tick, the uptick, but right here I want to see how long. You see, if I want you to focus with me for a second here, guys. It is trading at 83, let's say 80. Now, or 79. If you focus your mind that at this price, all what you're trying to do, and play this game with me, you are trying to see what would be the best price for you to buy. You're not looking to be a seller, to go short. You're looking either to buy, because now you're still on the side of the market, you're doing nothing. So right now, all what you're looking at this point is when and where to buy. You're not looking at selling. And you suddenly will have this kind of clarity in your head. This just simplicity, the clarity just opens you. You're looking to be a buyer, and that's what you want. And as long as it's above here, this is the stance somewhere around between 73 and 79, within those 6 ticks. And this is all what they are, 6 ticks. Nothing is going to change in the dynamics of the dollar yen for 6 ticks. It's nothing. So it all, and you see right there, this is what you want. And the longer it stays like this, and you see the buying comes in, what does this tell us? What does this behavior and the price action tell us? It tells us that they still want to buy. Nobody is coming into the market to short it. As long as it stays around the 80 level, and the longer it stays, wouldn't it convince you and convince me as buyers sitting on the sidelines that the market or the traders in the market are still keen on buying? So if everybody in the market is buying, then we should be looking how to time ourselves into buying and joining them in the same direction. And once this is done, and you see the simplicity is by just putting yourself in the mindset that as long as we're here, this is a buying mentality, so now we're going to behave in a buying mode. What we do every day, we go in, initially I'm just going to open 5 minutes so that you can have any questions. Once we identify this, we go to what we call the auto workspace, and we put multiple charts. You see, for example, here I have the pound CAD, the euro CAD, and the Aussie CAD. And in these are the instruments that we have decided that we're going to be trading today. And all what I have to do is to turn them on, turn the strategy, because we have automatic execution. So for example here, I'll show you, for example, so you decide which session you're going to be trading. So you turn it off and on. And okay, here is, for example, I'm going to show you in one, and then I'm going to open it to questions. This was the trade that we took in the previous session, following the same rules. So we took the trade based on the strength of the Canadian dollar and the weakness of the pound. Just taking a little bit longer than I expected. But you'll be able to see it quite clearly, the trade, and that's again goes back to the portfolio selection. That is your trades that we took this morning. This dashed line that you see here, that indicates a winning trade. So the first trade that we took in the morning when it started down, we shorted it at 159.78. And then we covered the trade because it started moving a little bit higher at 159.49. So we had about 30 pips on this trade. Then the market resumed the trend. The behavior continued. The auction continued, so we sell it again at 159.36, and before the session ended, before coming in, we covered it, so 158.40. So you started for, let's say we'll just add them up as one trade. So the first trade is 159.78. This is 158.94. So you had about 60 pips on average. That's not that's not bad. That's a good thing if you have 4 pairs and you can pick 2 of them that each of them give you 60 or 70 pips a day on that move. That is basically what you need. And if you look at the chart, guys, there is nothing on our charts other than the price structure. There's no indicators. There are visuals that tells us where to buy and where to sell. The package the software that we're using here, this is the only software in the world that is based on price behavior. There is no indicators. There is no moving averages. There is no this is momentum. You have a structure, you have a typical behavior, you identify your significant point, you identify your structure points, and you take the trades based upon that. And then you close the trade. So basically, to sum it up, you need 5 elements. One is you need to have a set of rules or a methodology that gives you clear way of how to trade the market, and what we use is what we call the price behavior, understanding the price and being a price purist. 2, you go with the portfolio selection. So I'm following a set of rules consistently. I do not change, I do not veer, not that they are by any means the holy grail, no, but they are good enough rules that gives me a statistical edge, that give me always high probability trades. So what leaves me is with some more money management. So that is an essence that allows me to be consistent. The second thing I need is my portfolio selection. And with that, I'm using the radar screen, identifying the strong currencies from the weak currencies, for identifying which ones I should be trading. So, for example, I shouldn't be touching the CAD or the yen. I should be looking at the dollar Swiss. And I have my significant points, or where the traders change their bias. Then, after I do having the rules and the set of my portfolio selection, I can go to the auto execution. The auto execution, what it does, it gives me the best possible timing to get into the trade. I don't need to reconsider. But it's not black box. I choose the portfolio. I choose the pound CAD. I choose the euro CAD. So now I took the highest probability instruments. Then I use the computer to get me in at the best possible time, and also to get me out at the best possible time. So I get the optimum entry and an optimum exit. And then what's left is the following up on the money management skills. Okay? So with that, my friend Dave, we have about another 15 minutes, I would say, or 10 minutes. I will open it to question and answers. If anybody has any questions, I'd be more than happy to answer. The mic is yours.
Great, thank you, Mike. I do have a few here from folks in the webinar. I'll just start back from one earlier. Samer, I hope I got that right, asks, so you take swing points as resistance or support. Once the price goes against the resistance or support, you take trade into the direction of the break. Is that correct?
In essence, yes, I can say that, but I want you to. There is the terminology issue of the swing point, and it is not a swing point per se. What we use is what we call a structure point. I mean, if you can see that wherever we have a horizontal line or a fine dashed line, that is what we call a structure point. So, for example, if you look at this, Samir, this here we have identified that as a structure point, which is for example, one of the biggest structure points in the dollar yen is the 91.73, so or the 87.10. So right going forward, if it gets below it is not now as, so right here, for example, it is above the 91.73. Right there, I am long, I am buying, and that structural point, as Amir, what it does, and that's something I didn't cover in the lecture. The beauty of it is that it gives you your exit. It gives you your stop. Because the only reason you're long is it's because above 91.73. So if it comes below 91.73, then you have no reason to stay in the trade. So automatically that is your stop, in essence, if you will. I mean, there are more techniques to it than that, but that's simply it is. And now if it comes back down, you're still going to take it short, and that is the move. So it is not exactly the right term to call it a swing. There is more to it to explain it than that, but that's the essence, yes. The other questions?
Thanks, Mike. From Munish, how many days do trades usually last? What's your time frame?
As long as it's going in my direction, I'm staying with it. I do not, I mean, let me show you, for example, the EuroCAD that we had. This is the, I'll put the long-term, this is what we call I'm putting the trade, and this is the EuroCAD, and you will see how long this trade is. As long as it's moving in my way, Manish, I'm staying with the trade. Look at this. See how long? We started this trade in May 15th, and we closed the trade on July 16th. This trade took 2 months, 60 days, and we took it from 156.30, let's say, to 135. It took 2,000 pips. So I'm staying with as long as it's moving, because if I take profits of Anish, then I'm predicting, and it is essential that we don't predict. Okay? All right.
All right. So keep a good thing going.
Yeah.
Can you go back for a moment to your your radar screen, and tell folks a little bit more about how this is generated? Is this a product that you sell or that you get somewhere?
This is one of the products that we have in Spyglass. The software has 5 components. One of them is the radar screen, and what the radar screen, guys, does, it scans the market every 5 seconds, and it comes up with, it shows you, these are the two important components. It allows us to gauge strength or weakness. You can tell which is the strongest of the strong, and these are the ones you want to buy, and you're looking for the weakest, and these are the ones you want to sell. And you can use you can do any combinations, if you will. So let's try something. Here is the dollar CAD. I have nothing here. This means that the dollar CAD is very neutral. It's not positive, it's not negative. So I want to do something with the dollar or with the Canadian. I want to see another pair, let's say the pound CAD, or let's say the Aussie CAD, for example. The Aussie CAD is slightly moving higher. So if I'm interested in doing anything with the Canadian, let's say I'm interested in the Canadian because yesterday they raised the interest rate, so I can say I will not do anything with the dollar CAD, but I will buy the Aussie CAD because the Aussie CAD is stronger than the dollar CAD. And if I want to buy something, I want to buy something that's strong for it to continue to go up. So that, and then it scans here and it tells us the signal. It tells you want to be long, you want to be short. Is it a strong reversal? It is a weak reversal. It gives you, so you gauge strength and weakness by the delta and the retracement, and it tells you which side of the market you want to be trading. The long point and the short points, this is we do every Sunday in our trade planning session. It's a webinar we join in every Sunday, and you can go to the site and maybe they will have a special offer for you. We do it at a ridiculously price, but anyway, Dave will discuss it with you. Then we have what we know, the second component is the software, is what we call the key lines. And these are zones that we identify as the neutral zones of the market. Below this, we want to be a seller, Above this, we want to be a buyer. So right here below the yellow lines, and this is, again, it's all simple. We explain everything to you. Right here, you don't have a choice except to sell. Buying is not an option. This is your risk. You're putting your stop on the other side, and you take the trade. So these are the key lines, are a very important component. The third is what we call this here. This is what we call the market side. This is not a moving average. As you see, it's not connected with each other. It ends at the end of every trading session, and it begins. This is pretty much close to your time and sales. If any of you are familiar with the futures, this is as close as you can get in stocks, and it's the time and sales. We're trying to see if the true intent in the market is people buying, or the true intent if they are selling, because people hide their orders and their size. And as I told you before, there are different strategies. But anyway, as long as the prices are above the market side, then again, out of the three options, buying is the only option. You're not looking at selling. Only, and you can see that intraday, it acts as pretty much as excellent support and excellent resistance, because, and this tells you that the intent that traders are buying. So the key lines, as I said, and the market side are a very important component. The third component is what we have is called the wave. And this is a gauge for momentum. I want you to look at these candles. You see them red and green. Once I put the wave, they will change color. They will either all green and all red. And this came up from when I was on the floor. I used to prepare these lines for the traders in the morning to buy and sell. So right there, they will be buying and they will be happy. And then the first sign you get a red candle, these guys would say, oops, the market is turning around, let's get out. And of course, they leave a ton of money on the table. So I had to come up with something to keep them in the market. So the best thing to do was, because they would go out at this red candle. So if the market is coming in with force and there is strong buying coming in, they shouldn't take profits over here. They should stay with the trade and take the profits all the way up, because the momentum is coming into the market. So instead of leaving those red so that they can go out, it is a gauge of momentum, and it will allow them to stay into the trade much, much longer. And you can see how now it makes a lot of sense to us. See now, they're all green, so nobody will going to take profits and get out. The fifth component is, as I showed you, the auto execution. And this will allow you can choose how many pairs you want to be trading, 1, 2, 3, 4, 5, it's up to you. And whichever you choose for it to take the trade automatically for you. And with that, you can, let's say, if your size is 10 lots or 10 mini lots, then you may let it take in 1 mini. So at least it gets you into the trade in a timely fashion, and then you can add to it as much as you want later. So basically the 5 components is the radar screen, the key lines, the market side. So again, you can see how simple it is your trading becomes, that you know exactly which side of the market you want to be. And after that, you have the auto execution, getting into the trade and out of the trade in a timely fashion. Yes, Dave? Yes, sir. I'm done.
Great. Close to the top of the hour here. I think we can take 1 or 2 more, and then I've got a little wrap-up slide. Mike, you referred earlier to a PowerPoint that was available. Can you send that to me, and I'll make sure that people have a link to it, if that's okay?
I can. Email? Sure, I can send it to you. And if you don't mind, I'd like to put the just in my email. If somebody wants to send me an email, that'll be
absolutely. You can just pop that into the chat window there, and everybody can see it if you like. And a question from Cliff about how you place your stops, and do you do trailing stops?
Yes. Initially there are several stops, Cliff. The initial stop is the moment you enter into the trade. I never use a money stop. I never use a money stop, i.e., I never say I'm only going to risk 20 pips on this trade or I'm only going to risk 30 pips on that trade. To me, to the style of my trading, that's wrong. Because the volatility of each market for each pair every day changes. So today the pound dollar might be very volatile, so if I put 20 pips stop, it might be too tight, I'll get whipsawed and stopped out. And that's why all of us, you'd see, you put a stop, you get stopped out, and you're on the right side of the market and it flies. So you have to choose your initial stop technically. I always use technical stops. So the key lines are very important components for the stops because they gauge, this is a volatility gauge. The key lines is a volatility gauge. So if I'm going to buy here, Cliff, then my stop is on the other side. And whatever that distance is, that is the size of my initial in stop. Okay? Then once I'm in the trade, the market side, this one now, theoretically, is my trailing stop if you so choose. Okay? It's not, but theoretically there it is. The exit, again, is based on when the chart structure changes, and you would see that if I put the strategy on, you would see how it will get us out in the best possible time. So I'll show you here right now. But so we technically, you want to give your trade room to move, and we use that the key lines for it. Okay. So basically, these are the 3 stops I used. Yes, Dave. I'll show you right now. I'll take another question until the screen comes up, David, if you want.
Okay. From Stephen, I hope I'm getting the sense of this right. After you identify a structural point, do you use a special time frame to create an entry point for that trade?
Okay. Again, this is, as you see, this is the trade from here, the one I was showing you. Right here, you took the trade. This was yesterday. You took the trade from there, 95, and you stay with the trade. The best statistical exit is right there from 95. You close at 95, you got 80 pips on the trade. When I pick a structural point, Stephen, what it does, it gives me my bias. It makes me focus now. I'm either buying if it's above the structural point or I'm waiting on the sidelines, but selling is no longer an option. So if I understand your question correctly, there are so many techniques that we teach around how to trade the structural point because if it's a structural point or a significant point, this means that it is a point that has been observed by a great deal of traders, a great number of traders, and with that case, there will be a lot of disagreements or a lot of volatility. I mean, you and I or anybody, we can never agree on anything. We always have contradictions. So let alone discussing the value of the euro dollar and or the pound dollar. So there are techniques on how to handle it, but the simple thing, for the sake of time, above it you only want to be a buyer, below it you want to be a seller, and the in-depth detail we try to explain, and it takes us like a whole day to teach you how to train the course, the significant point. Yes, sir. I already got one email from Linley, so I guess you have the correct email address. Yeah.
Okay, that's a good sign. Well, it's just a few minutes after the hour. I can see people are starting to drop off to get back to things. So I'm gonna, if it's all right with you, Mike, I'm gonna grab things back, do one more slide. We've got your email address for people, mikeb@spyglasstrading.co.uk, and I'll make sure that goes in the follow-up message as well.
Thank you.
Just take a second here. Okay, back to that. So Thank you, everybody, for taking the time, especially Mike and the folks at Spyglass for helping us out with some great information here today. I do apologize we didn't get to nearly all the questions here, but I hope they'll have some ongoing dialogue here. Please visit Currensee.com to learn more. You can sign up free. I'll be sending out an email to everybody. You can take advantage of Mike's weekly trade planning session, of which today was definitely a great preview. And as I said, you can also get in touch with Mike at spyglasstrading.co.uk. So thank you, Mike. Thank you, everybody. Happy trading. Have a great rest of the day, holidays as they come, and